Good afternoon, everyone. I had not realized when you're looking at all the speakers from the international side this afternoon that we would have so much in common. Both Philippe and I are working for reinsurance companies. Both of us are actuaries. Both of us have been professors teaching actuarial science at the university level. Both of us are Frenchmen from different parts of the world, though, Philippe being Swiss-French and myself being French-Canadian. So that means that for the next hour, all of us in the room will be using a second language to get through this presentation. So what I'd like to do this afternoon is talk to you about the Australian market. Unfortunately, I'm not going to sound as intelligent as Philippe. I am not including any fancy or statistical formulas in my presentation, so I will stick to the facts. My hope is to actually try to provide you ideas of things not to do based on what has been learned from the Australian market. Depending on which pamphlet you were looking at, Dean Abbott was supposed to be the presenter this afternoon. Unfortunately, Dean could not attend the presentation, and he asked me to step in. So I benefited from the fact that Dean had created the presentation, and I got to visit Colombia. So as part of a team effort, I say I'm the winner in this competition. But rest assured, Dean and I were both working on a project that took place in Australia. I myself spent over 3 months trying to study the market, try to find solutions for that market. And I've been involved for the last 2 years on a continuing basis to understand what happened and how to fix it. So what I'm hoping to provide you this afternoon is to give you insights into a disaster that dealt with group insurance, specifically disability, and hopefully that you can avoid these mistakes in your own market. So I'll provide a description of what happened, reasons why this happened, as well as some of the lessons learned from this. What happened can probably be depicted in a picture. For most of us, when we look at it, it was sort of a train wreck. So something that could have been avoided with some guidance and some insights looking at early trends. RGA, my employer, actually took a severe financial impact from what happened in Australia. So in 2013, we took a $274 million pre-tax charge for disability benefit in the Australian market. Of course, we were not alone. The market as a whole was suffering. Our competitors, Swiss Re, Munich Re, Hanover Re, as well as some of the direct companies, all took a significant financial hit to their bottom line because of what happened on disability. Overall, as you look at what happened, it was systematically a problem with the entire industry. So whether a reinsurer or some of the direct insurers listed on these slides, all of us suffered from some of the mistakes that had been made in that market. I'll give you a brief description of the Australian market. I think it's important for you to understand some of the basics to make sure that you can put this in your own context intelligently. So this is a picture of the Queen Victoria market for those of you that have been to Sydney, just as an introduction to that market. Group benefits in the Australian market is provided in a very different way than other markets. Of course, they do have group insurance provided through employers, so they do offer group dental, group medical, as well as monthly disability benefits offered through an employer-employee program. But a lot of the benefits are provided through what are called superannuation funds. So they're divided, so superannuation funds are retirement funds that have been created by the state. And there are different kinds of them. But essentially, it's forced retirement savings for all employees. So each employer every year has to pay into this fund in order to help the employees save money for their retirement. So that's the primary purpose of those funds, is for retirement savings. As part of these, as being a member of a fund, you do get additional benefits. But all of this is linked to your industry or your work. So you do have different super funds, as they often are called. Superannuation are referred to as super funds. It's like the CBUS, the Construction and Building Industry Super Fund, or the REST, the Retail Employees Superannuation Trust. The insurance industry has their own fund, so insurance employees have their own superannuation fund they can participate in. And as an employee, as you move from one industry to another, you may have to switch funds, in which case you're accumulating money into different pots of bank accounts, if you will, into these different trust companies that have been set up. So the law that ended up creating those superannuation funds essentially required today that 9.25% of each employee's salary be contributed into the employee fund by the employer. This contribution has increased significantly since its creation. So it's gone from about 3 or 4% in 1992 to what will likely be 12% in 2022. So it's a significant benefit that is being contributed by each employer. The superannuation fund actually does provide additional benefit. It does include life and total and permanent disability, TPD, which I believe you refer to in this market as ITP. In the presentation, I'll be using the acronym TPD. And all employees that are covered through the fund have this coverage for life insurance as well as for TPD. So a portion of that 9.25% contributed by each employer goes towards paying for those insurance. And this is an important fact. I'll come back to this later in the presentation as we look at premium changes that have taken place and what the impact could be for employees participating in those funds. If you look at the growth that came from the introduction of these superannuation funds, again, think of the insurance component that comes with this. The insurance market found this very attractive. The slide here is showing from 1999 to 2012 an annual compounded increase of around 16% in the premiums. So year over year, 16% growth in the market. Quite appealing for most of us, wouldn't you say? So the increases year over year were well above 10%. So the insurance industry was looking at this and thinking, this is a good deal, and we need to get as much as we can out of this. Yet there were problems coming up. So it's quite attractive. Insurance market is very interested in this. It's a growing market. And when you look at it on the surface, those people are employed. Most of them you expect are working. And I didn't touch any coming up. So we started to see deterioration in the experience around 2011, 2012. But nothing was as bad as 2013. The experience studies that were done in 2013 were showing increased incidence. So the number of claims being submitted and approved were increasing. There was increased severity. The benefit amounts that were being paid were quite bigger than they used to be. And on top of that, the lag between the time the disability occurred and when it was reported to the insurance company was getting longer and longer. Now, in most markets that I deal with around the world, there is a limit over which period of time that you can submit your claim to an insurance company. In most markets, claims have to be submitted within 1 year of the onset of a disability. There's a couple of reasons for this. The insurance company benefits from having very current information and something they can use. And for the insured themselves, they actually should get a benefit very close to the disability event. This money is supposed to help them cope with the situation, so it makes sense that they actually would be able to get the money quickly. However, in Australia, there is no such limit. Claims can be reported at any time in the future, and legally, there's no requirement for stopping that period over which we can report our claims. So the combination of all these three things led to problems with calculation of reserves, specifically the incurred but not reported reserves, so the IBNR. Basically looking at what claims have occurred that we don't know about yet, that have not yet been reporting to us. In addition to this, premium were guaranteed for a specific period of time. In most markets, when you think about group insurance, premium guarantees are limited to a year. Australia was looking to be more consumer-friendly and started to offer rate guarantees of 2 years or 3 years. So when you see the experience deteriorating very quickly and your hands are tied, you cannot react by changing premium rates, that makes the effect of this even worse, and that led to significant reserve increases, as I was showing earlier in the slides. This is the profitability shown in before tax profit in Australian dollars over the last few years. As I mentioned, experience 2011, 2012 was worse, it was getting worse, but nothing compared to 2013. And yet you look at this and you think, maybe it was just a bad year. If you look at 2014 and after, it looks like it went back to a reasonable level. And even though 2013 ended up, the losses were equivalent to a few years of profit, maybe it was just a bad year. And yet, as we'll go through in a few minutes, the reasons why this occurred, and what Australia did to try to get back into profitability, I think you'll find this a very interesting story, hopefully. So I'll come back to this slide in a few minutes. I was mentioning one of the problems that occurred is the long reporting period. If you look at the period here shown from 2004 to 2013, we're looking at the average time for someone to report a claim to the insurance company. And in 2004, on average, it was just under 10 months. And now, these days, we're looking at over 3 years on average to report a claim. So again, the amount of time between the incident causing the disability and when it's reported to the insurance company, we're looking at 3 years on average. So it's quite a long time. From an actuarial point of view, when you're trying to anticipate how many claims would be coming in the future that you don't know about yet, you have to determine this IBNR reserve, that incurred but not reported. And if you expect a scenario like this one, where most of the claims are reported fairly quickly, but you do see some of them taking a longer period, as many as 10 years perhaps, to be reported, it's quite difficult to estimate. But when you miss that target, because the reality is quite different, then you're looking at, if you expected your reported claim to be 67% of all the claims you expect within 2 years, and in reality, it's only 50%, then your financial results will be quite impacted by this over time, because losses will occur. You'll have more claims than what your reserve will have been set up for. And as you go over time, if we keep missing that target, we can easily get into financial trouble. And this is what we saw happen in 2013. This is a comparison of 2 different products from 2 different countries, but I think the comparison is still a smart one. At the bottom, we're seeing calendar quarters, and the red line is showing long-term disability in the US. So it's a monthly benefit that is paid on the group insurance side for people that are disabled. But here we're only looking at incidents, so that's why it's a fair comparison when we're looking at Australian TPD. And as you can see, after 8 quarters, so let's see if I can do this. So 8 is, oh, battery just died. Oh, there you go. So 8 quarters here. So you can tell that in the US, most of the claims have been reported by then, but in Australia, it's about 60% only of the claims that have been reported. So the impact of not having a maximum period to report your claim in is certainly having a problem here, causing a problem here. So what are the reasons for poor TPD experience in Australia? There was a change in the legal environment that occurred. What did that entail? It was actually on the workers' compensation side. So workers' compensation provides medical, disability, death benefit when people get injured at work. And there was a change because the government felt that the claims were taking too long, that the lawyers were getting too involved, and as a result of that, the benefit amounts were getting too high. It was too costly. So they imposed limits. They determined a preset amount for lump sum benefit. They categorized the disability types that would be paid under workers' compensation. And they also determined a certain threshold below which a lawyer could not get involved. It could not be litigated. So that greatly reduced the number of claims that could be litigated in that field. As a result of that, lawyers had less money, and they turned to TPD. And they thought that could be a way to increase their revenues by looking at a different, relatable type of claim. So they built awareness campaigns around TPD. They developed dedicated department to handle TPD claims, and they charged very large fees to get involved in those cases. And here we're showing Fund A and Fund B, which are actual funds from superannuation funds from Australia. So over a very short period of time, the number of claims where a lawyer was involved, where the claim was litigated, going from 10% to 50%, and in another case from 10% to 30% over a very short period of time. And the lawyers found this to be very lucrative. They actually could make money with this. Shine Lawyers is a very well-known one in Australia, and I'm not sure if you can see this very well, but it mentioned in the yellow highlights, additional revenues was generated from our emerging practice areas that include disability insurance and superannuation. It also goes on to say that they're expanding their practice in New South Wales and Victoria, provinces within Australia, and their revenue have doubled in those fields. So quite lucrative from them as well. So there was a change in legal environment which changed the focus for lawyers to start looking at TPD. And then they thought, well, let's make people aware of what's going on. So the lawyers started to do advertisement campaigns. They did surveys of superannuation members to know whether they were aware of these benefits and whether perhaps they could have claimed but never did. So some of them actually started to advertise that only 47% of people know that they have TPD coverage as part of their superannuation services. Another one quoted that 83% don't even know it's built into this superannuation fund. The funds themselves were under pressure in light of this, and they started to do flyers and commercials to advertise that we're not just a retirement fund, we actually provide other benefits. In part because the financial markets were not producing very good investment returns for these retirement funds. And as a result of that, they wanted to show their members that, you do get benefits, you get more out of this. So they had an interest in actually advertising this themselves. And you can see the lawyers started to be more and more in the news, showing awareness. The gap means that ill or injured Australian workers could be missing out on millions in superannuation insurance benefits. And please call us, we can help you. And then the associations of chronic illness also got involved. The Multiple Sclerosis Society, Parkinson's Society, Alzheimer's Disease Society, Arthritis Society started to tell their members, listen, you have this disease and you may be able to collect a benefit that you may not be aware of. So you had all these forces bringing awareness. And one of the things we started to monitor as part of our analysis of the Australian market was Google searches. And it sounds like a very odd thing for us to look at, but if you've ever used Google as a search engine, they do offer the ability for you to spot trends. So you ask Google to tell you, what is the trend in people searching for keywords, in this case, TPD, and you would see then by categories, TPD and lawyer, TPD and how to claim, TPD and funds. And we can see a surge in the number of claims, number of searches. Quite an interesting way to look at it for an insurance company, but definitely that was a trend that we should have picked up on, that we didn't monitor in the past. So you have all these companies, the firms, the funds, the associations, telling the public that you may or may not have to be unfit for any work or part-time work, only suitable for work that you have appropriate skills to perform. If you only done manual labor, the fact that you're able to do office work may not prevent you from collecting a benefit. It might be possible for the executor of a deceased person to make a TPD claim on behalf of the deceased person. If you have a critical illness, you may still be able to sign up for TPD coverage through your superannuation fund with no evidence of good health. So you have all these messages coming at the same time. So this awareness campaign was definitely very effective. And with this, the public awareness became mainstream. It was discussed on a regular basis in the media. We come in with Project Kangaroo, happily named Kangaroo for obvious reasons. So a few of us ended up moving to Australia for a few months in order to analyze what was going on. And as much as we could, it would be easy for us to blame the lawyers. We felt that the industry as a whole had to bear some of the blame as well. And this is what we'll be talking about. Because when we look at what happened, yes, the change in legal environment created this situation. Increased awareness certainly made people want to claim more, but there's at least 6 good reasons that the insurance market made some mistakes along the way that led to this, created an environment that actually made this easy for people to claim. And we'll go through them one by one. Benefit enrichment. There was widespread increase in the basic cover, so the amount of insurance that you're covered for without going through medical questionnaire or medical exam. The funds themselves, don't forget, significant premium was at stake. They wanted a big share of it. So what they thought is, let's make this as easy as possible for people to buy, and to buy as much as possible. So they started to double, or in some cases even more, increase the amount of basic coverage where people could get without any medical evidence and without any financial proof of income. It was purely based on what you could afford. And the increase in these automatic acceptance limits, the limits without medical evidence, was going up and up and up. And they were not tied to salary, so it made it very attractive to get this coverage. And if someone wanted to anti-select, it created this incentive to look at this closely. And if you could get a lawyer to help you, that was another reason to make this even more interesting. So what we saw is over that period, and here I'm showing 2004 to 2013, the increase in the average benefit amount for which people were actually covered. So the amount, sorry, I should rephrase this, the average paid claim over that period of time, as you can tell, increases significantly. And this over a 10-year period essentially went from an average of 25,000 TPD benefit to 125,000. So multiplied by 5 over a period of 10 years. And salaries did not multiply by 5 over that period of time. So definitely it was the insurance companies were making it easy for people to buy additional coverage without medical evidence. And we can see here, and this is for a specific fund, that once they decided to increase the default cover, the basic coverage without medical evidence by 30%, you can see that their loss ratio, so claims over premium, definitely went up significantly as a result of this. So they were being subjected to higher claims and more frequent claims. So you have a you have a market with rich benefits available to everybody, and then you include in the mix a definition of disability, which is very consumer friendly. So the definition over time changed from something that we would consider to be total and permanent. We think of this as very severe disability to something that was more consumer friendly. So it went from using a word such as enable to unlikely to work again. So a typical TPD definition, and there's a lot of variety, but a typical one would be, in the opinion of the insurer, after considering the medical and other evidence, you are unlikely ever to be able to engage in any occupation for which you are reasonably suited by education, training, and experience. On the surface, it looks fairly severe. From a legal point of view, and what the lawyers were arguing in court was that when the definition was unable ever to work again, we considered that to be a 90% chance that you will never work again. Unlikely ever, 80%. And as companies started to move towards using simply unlikely to work, they considered that to be a 51% chance of not working ever again. So you can tell that over a short period of time, the threshold, the criteria for qualifying for benefit was getting more and more consumer friendly. And as you look at a situation where, as Philippe was mentioning, somebody has an injury, hurts their back, and they may start to take medication, they might become dependent on that medication, they might start to worry about going back to work, may have anxiety, depression as a result of this. And my computer has disability. There you go. It can easily reach that point. The combination of a physical impairment with a mental nervous condition can certainly increase the degree of disability a person suffers from. Don't forget, TPD it's a one-time acceptance. It's not a monthly benefit where you have to continuously prove your disability. This is a one-time decision. Another definition, and I realize it is quite small, it is a single definition. Although it has 4 key components to it, it is a single definition. And I'll go through them just to give you an idea of how complicated and consumer-friendly the market got in Australia, or has gotten in Australia. The definition goes as follows. So the insured suffers an injury or sickness, and as a result, first angle to look at this, suffers at least a 20% reduction in the capacity to earn, so their income level as reduced by 20% compared to their pre-disability income. And they're not working, not getting an income from any other work, or they're not able to perform one or more income-producing duties from their own occupation and not generating other income, and follows the advice of a doctor. If that doesn't meet your criteria, you can also look at this as if you're unable to perform one or more duties of your occupation, which is important or essential, and I leave it to you to define what's important and essential in your job, to produce income. They're not engaged in any occupation, and they're following a doctor. If you don't meet under that definition, then you can look at it from a different angle, and so on. As you can see, the definition is very complicated, and you can imagine a lawyer looking at this will find flaws. A consumer looking at this will not know. it is quite complicated. And even as an actuary, and I've worked with disability products in several markets around the globe, when I look at Australia, I always wonder, if I had hair, I would pull it out. I would scratch my head and say, this doesn't make sense to anybody. And yet that's what they're facing. So we have rich benefits, we have definition of disability, which are complicated and consumer friendly, and then we look at the claim adjudication process. Growth in the superannuation funds and a high claim volume that ensued left the claim department short-staffed and inadequately trained. Unfortunately, the claim adjudicators were often viewed as clerical staff. And if you think of life insurance, as it was mentioned earlier, you have a death certificate. In most cases, it's black or white. They're dead or they're not. When it comes to disability, as you probably know, the decision process takes us into a gray zone. There's a lot of variety that can happen whether a person does qualify or not. And you need to have specialists, people who are true investigators going through this and gathering all the information that they can to make a decision. Unfortunately, the number of assessors and the quality of them was lacking. They didn't follow the policy terms. They weren't familiar with the legal terminations, that change of unable to unlikely to unable. They were looking at making decisions based on their own assessment, looking at diagnosis of cancer and thinking, well, that must be a permanent condition. And they were adjudicating more on their own moral compass, whether they knew somebody who had the same condition, whether they themselves think they deserve a benefit if they ever got disabled to this level. So it led to inconsistency in claim practices within a company as well as within the industry. So for the most part, they were just processors. They were relying significantly on the physician's notes, so the claimant's doctor, and which essentially became the person who made it possible for the insured to collect benefit. So much reliance was put on the doctor's opinion. And because we were not collecting information from good sources, such as rehabilitation physicians, psychologists, etc., to really assess fully the condition of the person, we were missing a lot of information. So that led to a lot of uneven claim practices. So we have rich benefit, definition of disability that are problematic, claim adjudication, which is not consistent, and then there's coverage eligibility. Who is entitled to be insured for these benefits? And the problem here occurred with the minimum number of working hours to be eligible for these benefits. Again, insurance companies wanted a big share of that business, and they wanted to make their offer more generous than others. So the minimum working hours to be eligible for insurance became lower and lower. In some cases, 10 hours per week was not uncommon to qualify for benefits, and sometimes less. One particular claim that we reviewed was someone who delivered pamphlet in your mailbox and was working 8 hours a week and was entitled to a claim. So there was little or no waiting period to be eligible for benefits. A lot of times when we see group insurance in most markets, people have to work a minimum of, let's say, 20 hours a week, and they have to prove that they're working 20 hours a week for a period of 30 days before they're eligible to be insured. This was not the case in Australia. Competitive pricing was the next problem that we faced. So the pricing assumptions were often considered in isolation. So every component of the pricing was looked at with very optimistic views. Keep in mind, the insurance market wanted a big share of this block of business. So everything was looked at as very optimistic, and when combined, all these assumptions together led to a lower premium than it should have been. They were including adjustment factors for mortality improvement, assuming that if people are living longer, they must be healthy. At the same time, they were putting improvements for morbidity improvements. They were looking at accidents at work, people getting sick at work, and the experience was getting better. So the working conditions in general for the Australian population was getting better, so that must mean that people will not claim. So they were including improvements for morbidity. And there was also the apathy factor. Keep in mind that for a long time, people were not aware of these benefits, that they had this. So for the most part, they looked at this and they thought, well, yeah, they exist, but people don't use them. So let's give a discount. Let's assume that a portion of the population will never claim for this. So all this combined led to very aggressive rates. The fact that the benefits were quite high, quite rich, was not considered in pricing. And as you can anticipate, the higher the benefit amount, the more incentive for people to look at this and think, can I get part of that money? So that leads to anti-selection, but that was not considered in pricing. And because underwriting limits, so non-medical limits, were getting higher and higher, we were not collecting information on people who had medical conditions until they applied for a very high benefit amount. So in some cases, there was not enough data, so the funds themselves, although they managed to serve the plan members, they were not providing the insurance company with a lot of good data. And because claims were lagging in the reporting, it was a bad combination. And as a pricing actuary, you can look at this and think, you look at the past to try to determine the future, but there comes a point where this combination of factor of awareness, richness of benefit, loosened claims practices and definitions all come together, and it's very hard to predict the future as a result of this. So there were other contributing factors which had a lesser impact, but still worth mentioning. Rate guarantees. Most group insurance in most markets will offer a 1-year guarantee. Some might go to 2 years. Australia, in order to be more competitive, the market was going to 3 years. So 3-year guarantee, and you're in a situation where the experience is worsening very fast, and it has a double impact for you. There are some blocks that you don't know how to evaluate. You are repricing them today because they're renewing, but your data is not reflective of the poor experience that is coming. In other cases, you can see the experience is bad, but you cannot change your premium for the next 2 years. So that was definitely a negative for the market. The size of the fund were so large that insurance companies wanted to do everything they could to get them. And that gave the fund, the superannuation fund, significant negotiation power. And they always wanted more and more for their plan members. Because there was no limit on the claim reporting period, we could see claims occurring several years after the fact. The worst one we saw was a claim that came in 10 years after the onset of disability. And you might think, well, how can this happen? And what made it worse is claim payments were being made to people who were back at work. But they were going back to the insurance company and saying, 5 years ago, I would have met that definition. And based on the evidence that was in place at the time, look at my medical records, I would have been paid a benefit. The fact that I went back to work doesn't matter because you didn't know this at the time. You would not have known this. And as such, I deserve a benefit. And you get a lawyer involved and the insurance company has to pay. So as I said, the worst we saw was going back 10 years and pay a claim to someone who was already back at work. The market structure had a misalignment of interests. You had the fund managers, the lawyers, the association, and the insurance companies, and the plan members all trying to work together in a system that had a lot of problems with it. So insufficient reporting and monitoring capabilities should have been caught earlier. I always recommend people to actually do any kind of monitoring they can do. They can spot trends early with this. And the economic environment was actually played against the Australian market. Now, the economic environment can be, there's two interpretations of this. A lot of times people will advance theories that if you're in a market where you're offering disability insurance and the economy goes bad, so unemployment rate goes up, as a result of that, you would expect that people will start to claim, either because they're depressed because of the economy, and as such, they may qualify for disability benefits. On the other hand, they may think, I'm going to lose my job, and I'm worried about this, and perhaps I can qualify for these benefits, and then I can ensure that I have some income coming in. I would say that that is not always true, and market situation actually make this better or worse. If you look at Germany, if you look at Canada and the US, and even Switzerland, through the last 2 recessions, the experience remained quite good. And I think the big difference between these markets and Australia was the fact that claim practices, contract wording, and pricing was very, very strong in those markets. Even though the economy was not performing well, the insurance companies were not trying to get more generous in order to get more market share, to get more premiums. The claim practices remained very solid through this. While Australia, because of the market conditions being so consumer-friendly, very generous, it suffered significantly because as the economy started to take a downturn, people turned to these benefits, including the lawyers, and they try to make money off of this. So here you are, so all these conditions, and again, we cannot just blame the lawyers. The insurance companies actually played a role in all this as well. So what are some of the lessons learned from this? Richness of benefit effect. So the higher the benefit amount, especially compared to a person's salary, the more incentive there is perhaps to claim. And it does open the door to anti-selection. And as an actuary, I don't believe we can price for anti-selection. So I'm more of a proponent to have benefits that are aligned with the need, looking at replacing income for a period of time, but reasonable compared to the income that the person has. An increased risk due to enhanced incentive to file a claim is what is produced by these rich benefits. So you do need to consider in pricing that the experience for higher benefit amounts tends to be worse than low benefit amounts. And this is a natural thing. You can do very good underwriting if you have the ability to do so. But regardless, we often see the experience being worse at higher benefit amounts on morbidity products. Policy provisions need to be very well organized. Loose policy provision will be exploited. And I encourage my actuaries that I work with in different markets to really read the contract and to sit down with their claim adjudicators and underwriters if the case allows, and to really make sure everybody understands the contract the same way. You want to limit the eligibility. You want to make sure that these people are working a certain number of hours, 20 hours or more, in order to qualify to be insured for these benefits to begin with. And if you're able to have a claim reporting period, which is limited. A year in many markets is quite good. Even 2 years might be good. Unlimited, as we saw in Australia, only led to problems. Invest in your claim staff. They need to have the right number of people, but also they need to be adequately trained to understand the policy and the definitions. They should not be relying simply on a doctor's opinion. They should be making their own assessment, gathering information from the employer in some cases, from the employee himself, claiming, their doctors, as well as your own insurance specialists, your psychological nurses, your rehabilitation specialists. All these people will provide you information that the claims adjudicator can then look at and get a picture in their mind. Can this person work or not? They need to be well trained. They should not be considered as clerks. On the pricing side, you need to consider the totality of the risk and not using just the most aggressive assumption along the way. Again, read contracts. I want to make sure people understand them well. And loopholes in contracts, so provisions that are poorly written, will lead to problems in the future. Even though historically they may not have been problematic, eventually this can happen. Limit premium rate guarantees in the face of uncertainty, because as the experience can change quite quickly, it's going to be very difficult to adjust. And think independently. Sometimes it's interesting to look at what the other insurance companies are doing, or in my case, other insurers are doing, and think, well, they must know what they're doing. So why not follow them? If they're offering a better price, they must know. They must have looked at it, and it must be our fault. We may not be looking at everything. So think independently. Be comfortable with your own assumptions. And risk management does matter. When we look at risk management, it's a lot of people associate this with experience analysis. We wait a few years, we start to see what the experience looks like, and then we determine, okay, are things good or bad? And what could have we done differently? But I encourage people to start to monitor early. For sure, I mentioned earlier the Google search. Not everybody can think of this. I have to say we saw this after the fact when we looked at the Australian market. But to look at the claims that are coming in very quickly after the policy is issued, and sit down with your lawyers, your doctors, your claim adjudicators, and say, okay, what's happening with those claims? And if you notice over time that the average claim amount increases significantly more than you expected, if you notice that the claims are coming in, or the disability date versus the issue date becomes shorter and shorter, there might be something going on, and the interpretation of your contract might be at risk as well. So we do encourage people to start to look at this. Try to define ways to spot trends early. Look at your average reserves per case. What are they changing and why? I come back to this slide, And the main reason I wanted to come back to this slide is, as I said earlier, you may look at this and think it was a bad year. And we can conclude that was the case. And given the history that I've given you, all the problems we identified, lessons from it, and perhaps things to consider, you might look at this and you may think, well, so Australia got themselves out of a problem. So a question for you is, how many of you think that the Australian market actually implemented changes to try to correct this? Anybody believes that the market corrected itself? Whether you don't know or if that was your answer, you're right. It did not. The market decided to increase premium rates. They found it very difficult to make changes to contracts. And that was the main problems that they incurred. Think again, these super funds are very big. They have a lot of power, a lot of negotiation power behind them. And they're saying, you know what? I don't want to change anything. I want to keep my benefits the same. I don't want my members to feel that they lost something. So increase my premium rates. And so the insurance companies did. And they increased premium rates by 100%, 150%, 200%. And as a result of this, profit went up. But nothing has changed. So the market condition have not changed. And you might think, well, why not? Because it is difficult to take something back. And Philip was mentioning this earlier, that he noticed in the early 90s problem in Australia, and they're back. And it's true. I'll give you another example from a different product, but I think you can appreciate this. Life insurance, individual life insurance in Australia does not have a suicide exclusion clause. Most markets, if a person buys insurance and commits suicide within a certain period of time, the claim will be excluded, the contract will be void. Essentially, we're saying, this is anti-selection. That's not the type of coverage we want to offer. Australia doesn't have this. You look at your claim, the life mortality claim experience in Australia, high propensity for suicides. And yet, when the insurance market was shown these statistics, the market said, well, perhaps, but I don't want to change my contract. I don't want to be perceived as being more restrictive. I want to remain consumer friendly. And you would think that would be an easy one to implement, because that is probably not the market insurers are going after. And if you think of all your policyholders, why should they be paying for this? So you would think it would be an easy change, and yet the market has resisted this. They have not implemented a suicide exclusion clause. So things like this you would think that could be easy were not implemented. So when you're looking at a contract where you're saying, let's change the disability definition so it's stricter, they're not interested. So as a result of this, profit has gone up because premium rates have gone up. But it has another problem with this. If you remember, those are superannuation funds. The money that is used to pay for these premium is the retirement money that each employer is contributing on behalf of their employees to this fund. This money is intended for retirement. But yet, a bigger and bigger portion of that contribution is going towards paying for this benefit. So in terms of fairness to the members, they may not be doing a disservice. They may be doing a disservice to the plan members, because they are eating away at their retirement funds by paying for these more generous benefits. So again, the market can correct itself in different ways, but I can certainly look at this and think that there could be other ways to do this. So I'm hoping that, again, beware of gaining comfort from what everybody else is doing when you look at your competitors. And hopefully some of the ideas some of the facts that I provided in this presentation can alert you of some of the problems that might be coming down for you in your own market. And I would be happy to take questions at this time or later on during the day. I'm also offering my email address at the bottom if you wanted to contact me directly. Thank you.